It offers a comprehensive range of accounting, tax, financial consulting services to meet the needs of clients, and providing innovative solutions and a comprehensive range of services that help clients take control of the business. Today we have a wonderful panel here. Alan is leading the panel. We have Suzanne Welch and we have Lauren Schreiber. And of course, we have a young social entrepreneur among us, Jas Crowe, who was regional Dragon's Den. I will very briefly introduce the speakers who are going to speak in the first half of the session. Alan is a partner in Crowe-Soberman's Audit and Advisory Group and has been with the firm since 1984. Alan is a member of management committee and was a partner in charge of education. Alan is also a former human resources partner. All the sessions that we have had in the earlier years, there has always been something unique in the session that the team brings, and I'm just waiting to see what's a surprise today. Lauren is a manager in the firm's Audit and Advisory Group. She provides insightful advice to business owners and entrepreneurs. She enjoys diversity of the work that provides her. More specifically, she provides a number of assurance services such as financial statement preparation and review, budget forecasting and cash flow projections and analysis. She also specializes in audit review, compilation, and can assist clients with personal tax planning and compliance needs. She regularly helps the nonprofits as well. And we have Suzanne. As a manager in the firm's Audit and Advisory Group, clients seek Suzanne's advice in business matters ranging from financial planning, tax return preparation. Her portfolio represents a diversity of her industrial experience. Not only has her resourcefulness proven effective in assisting corporate and not-for-profit clients in meeting their accounting and tax requirements, but her research and analysis shows clients where expenditures can be minimized and efforts optimized. So, without further ado, I request Alan to take the floor. Welcome, Alan. Thank you.
Good evening. I'd like to thank the TiE Institute and in particular, really, for having us once again participate in your annual seminar series. Before I pass the baton on to my colleagues, Lauren Schreiber and Suzanne Welch, I would like to start the evening off with a question. As you set up your new venture, I'm sure there's at least one, if not more, role models that you have and are looking to guide you on your journey. I'd like to hear from some of you as to who is your role model and why.
Who will volunteer first?
Go ahead. Suzanne, you want to just... Oh,
I don't.
Go ahead.
How about you?
You have it.
Yeah, my mom.
Okay.
Hardworking lady.
Why?
Did anything to make it happen.
Anyone else? It's not your question.
Anyone inspired by anyone? Someone they look up to?
Go ahead.
Ray Kroc for the system and Steve Jobs for the innovation.
Okay. Good. Go ahead.
Yeah, Alexander
I missed that person.
the Great.
Steve Jobs for innovation, you mentioned, sorry, the other person.
Ray Kroc, McDonald's
Ray Kroc, McDonald's. For?
for the system.
Okay. We had someone else. Alexander the Great, and what was the reason why?
And Gandhi. The reason why? Fearless and totally focused to conquer.
Okay. Lauren?
Mark Zuckerberg for not caving and selling to Yahoo in 2007.
Go ahead.
Oprah Winfrey.
Because?
She's very creative and remain focused and on top, cool-headed despite her fame and success.
Thank you. Well?
Oprah.
Oprah. Creative is one of the comments. So thanks. You got one more?
it's always the long, difficult names I struggle with. For always having another idea and always chasing the other idea.
Okay. Very good, thank you. In my experience, a successful entrepreneur needs to have a number of traits, of which you've mentioned a few of them. But one trait which stands out is being an effective communicator. Communication which is clear, which is simple, straightforward, and concise. To me, that's a sign of an excellent communicator. Well, tonight, as Lauren and Suzanne present to you our topic of cost structures and revenue streams and the relationship to managing cash flow, there will be communication objectives at key points of the presentation. So if anything is not conveyed to you in an understandable manner, please ask questions. Before the end, just one administrative note, before the end of our presentation, there is a door prize. If you haven't put in your card in the box, you can do it now or you can do it at the end of the presentation. So now I'd like to turn it over to Lauren and Suzanne. Thank you.
I'm a little shorter, so we have to address this slower slightly. So I know we've already been formally introduced, but I'm Lauren. We have Suzanne here as well. And we're going to be taking you through our first presentation of the night. It's on cost structures and revenue streams. We really want it to be as interactive and interesting for you as possible. So don't be shy. You have your Halloween candy to warm you up. And if you have any questions at all, please feel free to jump in, ask them as they come to mind. We also provide you with a notes page in your package, so if something comes to mind and you want to wait until the end, just jot it down. At the end of the presentation, we'll also be giving you our slide deck. So if you see something up there, you don't need to try to frantically write it down. We'll be providing you copies at the end. So that being said, we're really looking forward to going through this with you. And our presentation is going to be broken up into 4 sections. We'll start by discussing and providing an understanding of cost structures and revenue streams. And then we're going to go into explaining how to use cash flow, what is cash flow, and why it's so important.
So you'll also leave tonight knowing what a budget is, how to prepare one, and why they're so important, as well as learning some key metrics for interpreting your financial performance and analyzing trends.
So as Alan alluded to, a common thread throughout our whole presentation is communication and how you'll be able to interpret the performance of your business in order to measure success. And as I said, we'll leave plenty of time at the end to answer questions. So to start us off, we'll be going through cost structures and revenue streams. In this first section of our presentation, we really want to get you with an understanding of what they are. So as with any business, it's really important to know what you do and what your product is. So whether that product is something tangible or if it's a skill or a knowledge that you're selling. So really the key takeaway in this whole part of the presentation is to know your business and to know how you are going to define success for you.
All right, so there's 3 main types of cost structure categories. So when you think about cost structures, the idea is to identify where you spend most of your money in order to generate your product or your service. So there's labor, so that's all of your human input and your associated costs. That can be the payroll, the benefits, basically the cost of getting your employees set up to work, all of that. Capital is more of your one-time setup costs. You have to have large outlays for equipment, warehouses, vehicles, things like that. Material and product is the cost of the direct materials to generate your product. So that can be production materials, if you're purchasing products for resale, shipping costs, things like that. It's not so much the human part. And the cost structure will depend on the type of business that you're running. It'll also depend on what stage you are in that business. A lot of startups generally start with the capital and the labor because you're just getting started. You don't really have the product part down yet. So then you move into the other structures. It's also possible to fall under more than one structure at once, particularly in larger businesses that have more than one department. You could have your research department that's more labor intensive, your production department that's more the material and product. So it's not a one size thing.
Exactly.
So I was wondering if you can give us any ideas of companies that you think would fall under the different categories.
So let's start by going with a labor cost structure. Can someone think of an example of a company that might fall into that?
Facebook.
Okay.
Facebook.
Yeah, so software development, anything that's very human intensive.
Exactly.
Very example.
So what about an industry or a company that would have a capital cost structure?
Chemical factory?
General Motors.
Yeah, anything that's manufacturing is definitely capital, there's huge outlays just to get all the warehouses and production set up. Yeah.
What about real estate? Is that
I really think it depends on the kind of real estate that you're involved in. I mean, if you're looking at a salesperson, so a real estate professional, I think that would be more labor intensive, but if you're going into the actual development, I think it depends, like Suzanne said, on what stage your business is in.
And then product and material,
Maybe
yeah,
a-
yeah. Anything that you're reselling.
All right, so now that you understand and you're introduced to the types of cost structures that a business might have, the key is knowing the type that it relates to your business and knowing how that can define your performance and how you can measure your success. So with a labor-intensive cost structure, your focus is going to be on the management of your talent. So as Suzanne said, your people, HR, communications. So balancing the number of staff required to run your operations, balance between full-time employees, part-time employees, all the costs associated with employing those people. With a material-intensive cost structure, your focus is going to be on ensuring that you're managing your product costs as much as possible. So considerations will be optimal order quantities, preferred suppliers, who you're getting your products from, how far these suppliers are, how long it's going to take to get your product in, and how you'll receive and store your product. Lastly, we have the capital-intensive cost structure, and you're going to be focused more on the investment that you're making in this type of business. So separating out your upfront costs, how much money that you have available initially to purchase these large manufacturing machinery. You also want to weigh the benefit of how you're going to acquire these. So are you going to buy them outright, or are you potentially going to look into a leasing agreement where you're paying for these products on an ongoing basis? You also want to consider how you're going to manage these. So if you're going to have any maintenance contracts or service contracts, and how often you're going to be paying for repairs. So we're going to talk to you now about revenue streams, and they can really be broken down into two distinct types, one-time revenues or ongoing revenues. And as you can see up here, and it's pretty self-explanatory from their name, one-time revenues are really that point of sale to a customer or delivery of a service or contracted project, something that happens once. It doesn't guarantee that you're going to have that same customer again or generate repeat business from them. And then conversely, we have ongoing revenue streams, which are consistent. So they might represent monthly usage fees, maintenance contracts, anything with a service agreement, so like rental, licensing, or advertising. These ongoing streams might be based on a contract, and they might have a fixed term. So something like this, it's different to budget for because you know that those will consistently come in versus the one time where, it's harder to forecast and harder to anticipate when you're going to make those sales. Does anybody have an example, before we recap, of either of these revenue streams? And you can just think about what you purchase on a day-to-day basis, the things that you spend money on. Any one-time revenue streams?
consumer retail?
For sure. So I mean, pretty much any time you go to a mall, probably a one-time purchase. You even think about the companies that you're interested in starting up. What types of revenue streams do you have? All right. Kind of branching out. What kind of revenue stream would you prefer? Do you think it's easier to obtain multiple one-time customers or generate recurring business?
Ongoing.
Ongoing?
Go for that.
Yes.
For sure, definitely a goal, but how hard do you think it is to attract that loyal customer versus the one-time customer?
It's a challenging.
So it really relates to
It's
what?
challenging, but it's worthwhile to have customers coming not only, one time, but several times.
But it also, it also really depends on the product that you're selling or the business that you're in.
And sometimes it's the one-time customer that turn to ongoing customers,
Definitely.
depending on if they are happy.
Great. Okay, so now we've gone over the difference between the types of cost structures and how you can determine what type of cost structure what your focus will be. We also know about now a little bit of the revenue streams and how businesses can receive revenue, whether it be once from multiple customers or evenly from the same. And now I wanted to talk about cash flows. So what is cash flow? Cash flow is basically any money you have coming in and any money that you have going out. So it's so important because you need to think about all of the money that's coming in and where it's going, and allow you to, once you start analyzing your cash flows, it'll allow you to really understand how your business is being run and where everything is being spent. And you can start to plan ahead and use that as a tool for managing your business. So as I said, once you're managing your cash flow, you'll be able to anticipate. You can anticipate if you're going to have a cash shortfall, so if you're going to need extra financing, or if you're going to have some excess cash on hand. If you know when you're going to be receiving payments from customers, you can work with your suppliers to make sure that you're timing your payments for when you're going to be generating cash input. You can also work to stay on budget, so you'll be able to know whether you can afford to make certain purchases at that time, or if you should delay or work on a different financing schedule. You can anticipate entering a high or low volume period, so you can know how many staff you need to hire. But the most important thing about managing cash flows is that it really helps you to understand everything, and you can communicate that understanding with your potential financiers and investors. And you can really show that you understand how the financial aspect of your business is going.
And even to add to that, you can sort of think of any good idea or anything that you'd be really excited on, a project that you want to get going. And it's so easy to jump in, you're meeting with suppliers, or you're taking a look at products to buy to help you start your company, and things seem like a great idea. You want to get going all at once. And without that consideration of why cash flow and managing your cash flow is so important, you could be finding yourself running out of startup cash before you even have enough product to start selling, or before you even have a website developed. So it's really important to think about, you can even see in your handouts, the different items that can that you might have to think about when you're budgeting or coming up with your cash flows, your inflows and outflows, and take a step back before you jump the gun. So I'm going to talk now about analyzing cash flow, like I alluded to, looking for those major inflows and outflows, really trying to think about what's going to be coming in and what's going to be going out of your business. By having a cash flow, you're going to be able to see if your operation is actually producing cash or not. I mean, you're doing all this work, you're spending all this money, but is anything actually coming in? Do you have cash available to spend? What you're doing with that excess cash. I mean, we have up here, are you investing any of it? That might not happen at the startup of your business, but what you're doing with that cash and how you're maintaining it. Have you received any financing? And overall, looking at your cash flow, are you continuously generating money, or are you continuously spending the reserve that you have available? So you really want to determine at what point your operation is at and when you're starting to generate cash. So analyzing your cash flow is sort of tied into managing your cash flow. Now that you understand what it is and why it's important, we'll talk about ways where you can get your cash flow under control. So although we have yet to discuss budgeting, to be coming up next in part 3 of our presentation, you want to make sure that you're making use of an accounting software. So it doesn't have to be something fancy like Simply Accounting or QuickBooks or any other software that you might have heard of. It could be as simple as using Excel. Even if you're not familiar with computers, keeping track of something in a journal notebook. But the point is, you really want to make sure that you're tracking your expenses and you're tracking your revenues. Having that set up so you can easily see where your money's going and where your money's coming in, and the timing of both of those. You'll also want to start thinking about the seasonality of your business or product. Do you need to build up a stock of your products or anticipate for a really busy service time of the year? And if so, if you can anticipate the seasonality, are you going to have enough cash on hand to build up that reserve, get those products in order to sell them during that busy time? Make sure you don't run out of anything. It's also important to remember that making a sale isn't the same thing as receiving cash. So there is a really big distinction between an accrual basis, which is how a lot of financial statements are prepared, and a cash basis of accounting. And I mean, cash is the most important factor here. You can have all these sales, have all these invoices and contracts drafted up with customers, but if you haven't received that cash, I mean, what use is it? So you're not going to be able to run your business unless you actually get that cash in. So you really want to maintain good customer relationships. You want to be on top of those receivables that you're expecting to come in. Try to get those in as soon as possible. And like I said, keeping good records, knowing where you stand at any point in time is paramount. I mean, if you can open up a book and see how you're doing any day of the week, you'll know exactly where you stand.
Okay, so now we have some cash flow tips, just ways to help you try and keep more cash on hand, ways to manage cash. So the first one is that if you're registered for HST, make sure that you're filing as often as possible. The default is to file annually at first, but you can actually file monthly or quarterly. So especially at the beginning of a startup, you're generating a lot of expenses that you're paying HST on, so you can actually get that back a lot sooner.
The next tip we have from you is avoiding any unnecessary penalties or interest payments. So that can come down to, as Suzanne said, your sales tax filings, but any banking charges, any payment charges on your credit card, paying on time can really just save you money. Also, as you're in the startups of your business, talk to your banks, maybe they'll waive some service charges, maybe annual banking fees. Always look to cut down on those additional costs.
If you're going in to do any negotiations, make sure you do your own research first. You want to make sure that you're going and you're getting something that works for you. You don't want to have to start paying for things that you're not going to use, or pay more for things that you really shouldn't be paying. So do some comparison shopping.
Ensure you don't go in intending blindly, right? If you're meeting with a professional on something, or you're going in to purchase a piece of equipment, that person could be giving you a figure or an amount that's, way out of line with what the market is saying. So, I mean, researching is really important, and to go along with that, free researching. So really make use of those free tools. I mean, I'm sure everyone goes on the internet regularly. There's a ton of reputable resources online, tons of websites that you can make use of, which can give you a ton of information.
Depending on what your startup is doing, you can also look into getting government funding. There are a lot of grants out there. Make sure you look at both federal and provincial, because the Ontario government has different grants than the federal government, and they might have different things available, or you can overlap funding. There's also what people call SHRED. It's scientific research and experimental development. So it's if you're generating new ideas, creating new products, you can sometimes qualify and get tax credits back on money that you spent.
Just one other thing on the grants and SHRED, there are companies out there that do have, on a contingency fee basis, can get you some of these grants and scientific research credits, so that it helps from a cash flow perspective, because you don't pay them until the money comes to you.
So those types of businesses will make sure that you're filing that SHRED claim correctly, and ensuring you're getting the maximum credit possible, and then taking a fee based on the successful receipt of that claim.
What's a reasonable fee?
A reasonable fee is obviously what you can negotiate. Some of the firms that do this have a 3 to 4 year contract, and they charge about 25%.
But can't you also just go to a good accountant who's familiar with SHREDs, and that's what I've done. I've been very successful with SHREDs.
Some accounting firms, the accounting firms will complete the tax returns, but the actual project information that's required in a prescribed manner can sometimes be done in-house by the actual, like yourself, if you have that capability. Some accounting firms do the actual, larger firms do it, but in a lot of cases there are special consultants who will write the actual project.
I would say you've developed your product and you know your product. You should write the description yourself, because otherwise, I think.
Well, I'll tell you where that sometimes falls down. We've had clients who try to do it on their own, and didn't do it properly and got turned down by the government. These consulting firms have their own engineers and specialists who can actually know more than for sure that us as accountants would know, because we're not specialists in engineering, etc. And so they'll write the report, they'll provide the input on the actual dollars with using us as a resource. But their mainstay is two things. They can write the report better than most, and two is if you get audited, they've had a lot of interaction with the CRA, with the tax department, and know what is working and what isn't working. And this is a case in point because we have a number of organizations that we have kind of as I wouldn't call it affiliates, but we use for our clients. We're having one of them come in the next 10, 12 days to give us an update on the various programs, some of which we know, but they have different perspectives and different experiences that they could bring to us so we can help our own clients. Hope I've answered your question.
I think it also depends on how familiar you are with the SHRED programs and how to apply and how the applications work and how involved you are with the development of your own product. So I would say if you're very familiar and you know what needs to be laid out in these claims, it may make sense just to stick with how you're going now with your accountant and completing the application yourself. But if you're less familiar, maybe it's the first time you're filing one of these claims, or you really don't know anything about it, but you think you might be eligible, it might be good to speak with someone. Another tip we have is identifying your needs versus wants. So how I was talking about before, you go in and you're really excited about all these options available to you. We really encourage you to take a step back and think about what do you need to get off the ground? What are the crucial items that are going to help you get through the startup phase of your operations versus the wants, where it might be nice to plan for this down the road or to see this as a goal that you want to get by maybe 6 months in, 1 year in. Kind of break those down into two categories.
Okay, so be wary of buying in bulk, especially if you don't know how much you're going to need. Yes, you get a lower unit price for higher volume, but if you then have to store it, you have to pay more upfront to buy more of it. So just don't get sucked into the lowest unit cost. Really think about how much you need and how much you can store.
Especially if there's any sort of obsolescence to your product or to your business. And the last tip we have for you is negotiate for the short term. And this really applies to any contracts, leases, anything that you're entering into in that respect. You really don't want to lock yourself in and commit yourself to paying a certain amount of money for a long period of time. It might be slightly more expensive to go into a no-term contract or a shorter-term lease, but if you don't know where you are with your operations and your cash flow, it might be something that you're willing to pay that small premium for, as opposed to tying yourself in.
It just gives you a bit more flexibility
For sure.
for any changes that might come up. So that's the basics of cash flow. So it's just the basic formula, cash in less cash out is your cash flow. So it's just important to always know how much cash you have on hand, how much cash you have available to spend, what your upcoming commitments are and what's going to be coming in. And just always try and think of different ways to keep improving your cash flow and managing the money that's coming in and going out.
So before we move on, does anyone have any questions about the cash flow portion of our presentation? Anything we haven't addressed, or just anything you want to share or say?
No, but I just want to, is it possible we get maybe copies, or can you email us your presentation? Would that be possible?
Yeah, for those of you who came in a little bit after, we have presentations of our entire slide deck that we'll be handing out after we're completed.
Oh,
So you'll have everything, you don't have to worry about writing anything down.
oh, thank you.
And
And
they're
once-
also posting it on the website afterwards.
The presentation as well as the videos will be available on the website.
So you can watch this again over and over. Yeah.
Just like your favorite shows.
Regarding SHRED, is that a tax credit for all of your expenditures if the entirety of your business is developing something new and innovative, or just strictly on the costs exactly around the development of that new and innovative product?
So SHRED Shred really focuses on the costs that are associated with developing the new technology or new ideas.
So
That's actually feasible and it's gonna be put into production.
But would like the cost of advertising that new and innovative
No.
It's
thing?
usually based
No.
on salaries of the people that are working on it and the costs associated with that, like if you have to buy equipment or things like that.
So
But it
for-
really depends on it and where you are at the stage.
So for example, if you have an individual employee who is making 75,000 and they spend half their time on operations and the other half on research, that's that latter half is what they can claim. And you need to keep good records in case you get audited as to the amount of time spent in that latter area.
I'm just curious from your point of view whether or not the Shreds program, I'm just curious from your point of view whether the Shreds program is as good as it has been in the past or better given the changes that have been made in the last year.
My understanding is, an experience is, well, for starters, the changes are more restrictive, so there's less opportunity in terms of getting the dollars that you could have gotten comparing before the budget they had in last winter, and that it's going to apply to, I believe, to this coming calendar year. We as a country, I believe, are behind some others in terms of the opportunities for scientific research credits. And when you read about the lack of productivity in that and in Canada, because we're such a service-oriented country plus our raw materials, that there could be better programs. But I don't write, you know, it's up to, you know, organizations like the CFIB, you know, Federation of Independent Business, to push our governments in that regard to improve it. But that being said, I do have a number of clients who have done very well with the programs and that I've encouraged, and it took a while to get them on board because in one case, it was one of the shareholders drafting up the vast majority of the written project. And when I finally got them on board and they saw the results and how positive, it gave them encouragement to continue to do so. So, could be better.
Was there another question? I thought I saw.
Okay, your analysis, is it applicable to social enterprise?
Well, I think it really depends what sort of social enterprise or what type of business or organization you're interested in starting up. Do you have something in mind? Can you be a bit more specific?
Go ahead.
Okay, for instance, you know, in the recent time or changing time, a lot of non-for-profit organizations are encouraged to start looking towards, you know, raising some of their own funds, you know, as opposed to being dependent on government and all that. And as a result, social enterprises are coming in vogue. They are becoming more popular. So say for instance, organizations like Goodwill, Salvation Army, which were in not-for-profit, but at the same time, they have a business. And so that's an example. Another example is something like a computer, refurbishing, picking up computers, refurbishing them and selling them, you know, as a way of also entering the social enterprise.
You want to answer?
Cash flow analysis and cash flow management would apply to any situation where you make expenditures and get money from somewhere else. So it could apply to even running your family or running a household, social enterprise, or anything.
I mean, like living
I
on a
couldn't put it
day-to-day
better
basis.
myself.
You could think about your personal cash flow too, right?
Exactly.
I mean, your employment, where you're getting your money from, how fast you're spending your money. These tips and cash flow management, even budgeting, it really extends far past just a for-profit business or organization. Especially with nonprofits, you really need to think about how you're getting those funds in and what you need to do in order to raise awareness, attract people to your business. But you know, if you have to spend money to do so, where's that money coming in from?
And companies are known to live for a couple of years with negative profit, but with negative cash flow, you can't even survive a month.
And for nonprofits, that is where we see organizations struggle on the expenditure side. Because they really, unless they have ongoing grants or contributions, whether it be from the banks or the government, it's easy for them to spend. And what gets them in control, when, if you want to call it a tip, is if they're getting monies from a government agency, they may have certain requirements on how that money's spent and how they answer for it so that it's put to the proper use and they're limited by the amount they get in. But as Lalit said, and as Lauren said, these tips apply in everything you do in your life, whether it's personal, whether it's an organization, profit-oriented, non-profit-oriented, it doesn't matter. Our own governments, you know, we can talk for hours about wastage of monies, provincial, municipal, and federal level, but I don't want to have a fight here tonight.
The difference is we just can't print more. So once it's done, it's done.
Okay, there's one more question in the back.
Yeah, I was wondering if there's an equivalent of SHRED for social enterprises, or is there some portal where one could get information on that?
Off the top of my head, I don't have the answer, but at the break, I can give you a name of a person you can call at one of these organizations, and you could ask him and see if he can lead you in the right direction.
There's a very good website called mentorworks.ca that gives you a list of all the grants and funding possibilities on the provincial and federal level.
Thank you. All right, so moving on to the third section of our presentation, we're going into budgets.
So we're going to talk about how they relate to cash flow and how you can use the cash flow analysis that you've done to prepare your budget, and just talk about what kind of important tool they are for you to use in your business or nonprofit. So before you prepare your budget, you should go through and analyze your cash flow to give you an idea of where you're spending money, where you're getting money, how things have been going. Then you take that, and your budget is really your cash flow information, but you organize it in a manner that will estimate your expected performance. So it's basically the way of organizing your information to present your plan for the next, usually a year, monthly or yearly. So we'll look at your revenues and expenses, and you can use it to project your future cash flows and just communicate that to everyone that you need to. So when you're preparing your budget, there's 4 steps. The first thing to do is to prepare your sales forecast. How much sales are you going to generate in the next year? If you're still in the startup and development phase, that's usually easy. It's usually 0, so it's the fastest step. Once you have that, you can figure out how you're going to generate your cash flows. As we said before, just because you make sales doesn't mean you get the money. So you need to anticipate when you're going to be receiving the cash. So you need to look at how you're structuring your contract. If you're going to get paid on delivery, if you're going to get part up front, or there's like periodic payments. You can use that to anticipate, to make the timeline of when the money's coming in. You also want to look at any other cash that's coming in. If you have financing, you have tiered financing that they'll release funds on different dates. So then you move on and do the same thing with your outflows. Figure out everything that you need to spend money on and when. So if you're going to be generating a lot of sales, when do you need to buy inventory? When do you need to start paying rent somewhere? Do you have a lease term that gives you free rent for a period, and then you're going to have to start paying rent halfway through the year? When do you need to start paying back your loans? Things like that. So you take all of that information to come up with your bottom line, your cash flow.
And in the handouts that we've provided, we have, not exhaustive, but a really detailed list of cash inflows and cash outflows that can be used in the budgeting process. So they really help you identify sort of those things that you might not have realized that you need to pay, but something to consider going forward.
And the handout does combine both personal and business, especially with startups. If you're providing your own funding, it's a good idea to get your personal funding under control so that you know exactly he has some tips for developing your budgets.
So the first one is just really start brainstorming. Make a list of all your assumptions, sort of the things that you're going to think about going forward and projecting your financial performance or how you envision your business growing for the next year, whatever time frame you're thinking of budgeting for.
So you want to make sure that your budget is consistent with your business plan and your goals. If you know that you're going to be developing product for 6 months, you don't want to have a budget that's expecting sales for those 6 months. Same with if you have contracts, you want to make sure you put all those contracts in so you know exactly how much to anticipate.
You can also look at past performance or current market conditions. So you might not have directly applicable past performance yourself, but looking into other startups, reaching out to people who have experience in the industry or with similar businesses, what struggles they might have faced, what challenges they found they had when preparing their budget or just running their business for that startup phase.
You want to look at one-time expenses versus recurring expenses. So at the beginning, you have all of your startup costs, and then you'll just have maintenance of those costs. So anything that's one time, you probably have it all at the beginning, you need a big chunk of financing, but then after that, you probably need less on an ongoing basis.
We really want you to be conservative. Plan for emergencies and contingencies. Make sure you have that buffer in. I know it might be great to get sales increase of 100% from month 2 to month 12, but is that reasonable? And is that in line with, like I said before, the market and what's actually going to happen, what's reasonable to expect to happen?
And then consider the period covered by your budget. Most budgets go for a year, but I think it's good, especially the first time you're doing your budget, it's good to do it monthly because just the timing, you might pay for something 1 month and not have to pay for it the next month, and it'll just give you a better starting point.
So we're going to move into monitoring your budget, and I just really want to stress that the budget is a forecast of how you think you're going to do, a very, as accurate as possible forecast of your expectations that you're going to be using as a benchmark for measuring your actual performance against. So your budget isn't something that you're changing every week and updating with your most recent financial results or your most recent sales contracts or expenses. It's at a point in time, a snapshot of how you see yourself progressing. And the whole tool of budgeting is using that benchmark or that expectation and measuring your current performance against that. So if you budgeted out for 1 month and you thought you would get this much revenue and spend this much money, taking a look at your actual results close to the end of that month and how you did. Was that in line with what you thought was going to happen, or were you really far off? And if you were really far off, knowing that you had all these assumptions to create your budget, how can you drill down and find out what kind of led you astray? So the key thing here is a budget is only useful if you use it. Spending all that time to create a budget and then never looking at it again, it's not going to be beneficial. There was no point in creating it in the first place. So something that's really helpful for you to set up your budget is, like I said before in the cash flow section, keeping financial records up to date. Also setting up your financial records in a way that mirrors the budget that you've created. And when I say that, I'm thinking of the actual line items. So if you were to create a financial statement, you have the different types of revenues that are coming in, or maybe your different services or your different products, and then the expenses and the payments that you have by type. If you budget, or if you create your budget in the same framework that you track your revenues and expenses, it's going to be a lot easier for you to use your financial records or use your accounting records and compare those results to your budget. You also want to review, like I said before, your short-term and long-term budgets regularly, and without completely overhauling that budget. If something happens 6 months into your business and you know that it's going to change your performance for the second half of the year, it is important at that point to reevaluate your budget with that new information that will impact the rest of the term.
Okay, so now that you know what a budget is and how to prepare one, we hope that you'll use the information that we've provided in your handouts to prepare your own budgets. We do suggest that you do it for personal and business. There's also a listing there of typical startup costs that you can look at and make sure that you're considering all of the different things you might encounter. And the budget process, as Lauren said, is ongoing. You need to keep it up to date and relevant. Just try not to get caught up in continually updating your budget. So they'll help you plan ahead and they can help you communicate your plan to others.
So now that we're done discussing cash flows, budgeting, do we have any questions so far? Has anyone ever done up a budget, whether it be for personal or for business? Has anyone gone through that exercise? That's awesome. So what struggles have you found, or what have been the most challenging parts of creating that budget?
They're always wrong.
You're all wrong. So it's the same thing with anything, right? Good information in is good information out. If it's just a haphazard budget, it's really not, it might not be useful.
I think to have a good budget, you have to have data from previous, like from history. And when you're a startup, you have no history. So
You
it's
have no
impossible
history,
to.
but you can probably find history of other companies.
Yeah, but there's always variance, you know, if you
Exactly.
look, you know, everybody says go look at the stock market and find out like something that's similar to what you're trying to start up. But it's like, those, I mean, that's such well-established, settled system that it's very hard to match that kind of.
When you're a startup, you need to review it very often, and sometimes even weekly, and revise the rest of it accordingly.
But even as a learning exercise too, right? Looking at what you think you were going to have to spend or what you thought you were going to earn, even without that historic information, if you compare your actual results to that budget, I mean, you might just learn a ton about what occurred during the past month or 2 months or so that you might not have stopped to consider if you hadn't done that comparison. So thinking about what you now know that you didn't know then.
It can help you look at it and you can really learn from it, and you see the variances and you look at them and figure out why you have these differences. Is it a certain product line? Is it just expenses are too high, too many employees, something like that over there, and then.
Yeah. My question is, how can I, tell my group members to concentrate on the budget for, to give you a background of our organization. It's a non-profit, but recently we voted to become co-op. Now, most of the members are activists and they are not capitalists. And in fact, they want kind of a barter system in generating, I don't know if it's an income or what, but that's a kind of system that they want to have. Now, how can I, communicate with them and tell them how important it is to have some kind of budget? Right now, we are down to 25,000. We started with 75,000, and this year we have 25,000 left. Now, what is the best way to communicate with them?
Can I ask you a question?
Yes.
What inflows do you get, and how do you get them?
We do events. We sell food, organic and healthy foods. But the system is pay what you can, and it shows that it's not sustainable, and so we're really struggling to come up with some kind of,
I think that people, and again, it may be different groups within the organization, they need to be able to understand that once the money runs out, whatever they wanted to do in terms of their activities are going to be limited. So they have to first come up with ways to bring in some money so they can use those funds to go forward. And if you've got 25,000 left, and for argument's sake you spent 50 over the last 9 months or 10 months, by demonstrating, okay, here's what we spent, here's what's come in, we've got 25,000 for argument's sake to spend for the rest of this calendar year, but if we don't have anything coming in, our activities stop. So their motivation is to try to bring in money as well as use the money they are, otherwise they can't do what they want to do. It's more from a macro perspective first, getting the message across, and then working together and brainstorming and say, okay, here are ways we brought in. Has it worked? Has it worked well? If it hasn't, are there other ways of doing it? we have always found in our own office that by brainstorming and working as a team, that's where the ideas come from. It's not coming from me or Lauren or Suzanne alone, it's coming from us having a discussion first and saying, okay, what are our objectives? In your case, I think your first objective is, I need income or inflows to allow us to continue the activities that we want to continue. That's step one. How do we go about getting those inflows? What has worked, what hasn't worked? And realizing that by the end of the year, we're not going to have any money in the bank to continue our activities. So let's focus to some degree and maybe step back a little bit on what we're doing to bring the inflows to leave a cushion so that we could continue our activities.
And you said you started with 75,000 and you're down to 25, so, I mean.
That was, we started 2 years ago.
So you do have that historic data that you can look at.
Yes.
Hopefully, it's somewhere in there. But you can look back on what's happened in the past 2 years and how you've gone from 75 down to 25, and you can sort of look at the expenditures that you've made along the way, and knowing that you'll probably, if not more, spend the same amount, how fast is that going to take you until you need more, and how do you have to budget and use that budgeting to plan for those cash inflows in order to, not run down to zero?
Thank you very much.
The other thing you can do is that
Very interesting.
you wanna get
There
buy-in
are three
from-
elements in your endeavor. One is the size of your operation, another is the cost, and third is what you get from these people who pay whatever they want to pay. And you got to balance them. So either you reduce your costs, or you get more revenue, or you reduce the size of your operation.
Well, we're all volunteers.
Yeah, so you're doing free work, but you're buying organic inputs, cooking it, and perhaps serving it to some needy people? Is that the case?
Yes.
Yeah, so,
One problem is, St. James Town is not, it's low-income families there. And what we experience is that when it's pay what you can, and we put a limit, let's say $5, but they couldn't pay that much for it.
yeah, so either you serve lesser number of people, or reduce the cost of the inputs, or fix a lower price, one of the things,
Or get a sponsor.
Yeah, or get a sponsor.
But I mean, the budgeting tool will help you identify that point. If you don't have enough money, you'll see, your inflows are only, let's say, $100 every time you go out and serve the food and do the food service, but it costs you $150. You know that you can budget if you're doing 3 food trips a month, you're out $150 every month. And so that negative, ending point at the end of each weekly or monthly budget, that'll help you see that you need more inflows and you need to plan for those.
Yeah, I think another difficulty that I experience is in budgeting is when you have to plan for either 1 year, 2 or 3 years in advance. Let's say from this year, and considering inflation, and so sometimes I find myself either under budgeting and all that, so you budget and maybe you find that, but when you get there, so it's kind of you have under budgeting. How is the best way to address that?
Well, I think Lauren actually did address it, but just to add to it is that you do an ongoing, first of all, the further a budget goes out, the less reliable it is because circumstances can change. But as both Lauren and Suzanne said, you monitor it, right? So the first thing they said is there's always assumptions when you do a budget. And yes, there's inflation, but generally inflation in this country is pretty benign at the moment. Sorry, but it's pretty benign at the moment. So unless you're in an industry or in an organization where inflation happens to be more than a few percent, the impact at least on the revenue side may not be that much. It's actual, if it's a profit-oriented organization, it's got to be number of units you can sell. So the key is, what are the assumptions? What's the industry you're in or the area you're in? where's your source of revenues, and monitoring it, so that if it's a startup, as Lalit says, you'll tend to do it more often. But if you're going 2-3 years, you're going to have to evaluate maybe after 6 months, the next 2 years, and see if something's changed. And, or every quarter. So every time if you do a 2-year budget, when one quarter ends, you add another quarter at the tail end of it. But the monitoring is the key perspective of major aspects of your revenue and your expenditures. Some you don't have to monitor. If you've got a lease in a place, and you know what the specifics are and what your lease term is. If there's a CPI, consumer price index increase on your base rent, or is it fixed for the first number of years, you'll know. It's set. But there are other areas that are more sensitive to various aspects of your specific business. So the key is monitoring.
And I think you also just want to be careful about the timeline that you're forecasting for. I know it's important to have some sort of idea of where you're going to be in the next 3 years, but if you're thinking about your startup company, 3 years might be a really ambitious budget time frame to be working with. You might want to focus a little bit more on a shorter timeline. All right, so we're moving on to the last sort of segment of our presentation, which is financial statements and data analysis. And throughout this part of the presentation, we really want to provide you with the metrics available for interpreting your financial performance and allow you to analyze trends. So through this section, we'll go through the components of your financial statements, helpful financial metrics, and also practical examples to sort of guide you through those calculations.
There is also a set of sample financial statements in your handout for you to refer to. If you want to while we go along, you don't have to. So the main components of the financial statement are the balance sheet, the income statement, statement of retained earnings and equity, and the cash flow statement and the notes. Cash flow and notes are not always included.
So before we actually go into this section of the presentation, the actual components of the financial statements, before we go into the calculations, do you want us to do that? Is that something that's going to be beneficial for you?
Yes.
Not a problem. Happy to do that.
Okay, so the balance sheet. There's different names for the balance sheet, but basically the balance sheet details everything that you own and everything that you owe. So everything you own is your assets, and then your liabilities are what you owe, and equity is everything that has been retained in the company. So the balance sheet provides a snapshot of the financial position at a certain date. It's always the one date, so it's not a moment. It's not over a period. It's exactly like if I did a balance sheet today, it would be everything that I have on October 31st on Halloween. Yes. So your balance sheet, because it's balanced, is your assets, which equals your liabilities and your equity. So the components of the balance sheet are the assets. As I said, this is things that you own, so things of enduring value, or things that you have a claim on. So it typically consists of things that you can use to generate income, so things like your inventory and your property, or things like cash that you have on hand, or something you have a claim on, like any receivables that you're owed. We generally list it in order of liquidity, so that's how fast it can be converted into cash. And the only other thing to remember is that it's always listed at original cost. So if you buy property that goes up in value, you still only see the original cost on the balance sheet. So right after the assets is the liabilities, is everything that you need that you owe out. So what you'll be paying out to your suppliers, any financing that you've got in will be repaid, any deferred revenue, so if you've gotten deposits from clients, any taxes owing. They're generally listed based on when you have to repay them. So the shorter term will be at the top, like your accounts payable, which is to your suppliers. Your financing will probably be lower down, so it'll be a longer term. And yeah, do you have a question?
So could you repeat that part again for assets? You said that if your price of your building goes up, it still remains the same on your balance sheet, on your books.
So it depends what reporting framework you're preparing your financial statements under, but typically if you're just preparing your financial statements to show your snapshot where you are at a certain time. If you buy a building for $100,000 to run your operations out of, it could be 10 years since you've owned that building, and if it's in Toronto, guaranteed that land has gone up in value. That building is worth more than it was when you bought it. Your balance sheet isn't going to reflect that. It's going to show the cost that you bought your building at. So that's where you sort of move away from the balance sheet as a valuation tool of what someone would buy your company for or buy your assets for versus what you actually paid for them.
Yeah, it'll show the cost of the asset at the time you purchase it. So to calculate, you take the retained earnings at the previous period, or 0 if you're starting, and any earnings or loss that you had, and then minus anything that you paid out as dividends.
So before we move on to the income statement, does everyone understand the basic formula on the balance sheet that your assets equal your liabilities plus your equities?
Yeah?
Because your equity, all the income that you earn from your income statement, that Suzanne is going to talk about next, all that income is going to flow through to your balance sheet via that equity number. So all those earnings are going to come into that balance sheet at a point in time. And that represents your earnings net of what you've spent money on or owe money to, so your assets and your liabilities. And that's sort of how they balance each other out. Okay.
Okay, so the income statement is also referred to as your profit and loss, that's the P&L. The statement of earnings, some people also refer to it as the bottom line. So this statement is over a period of time. So it's usually over 1 year. You can do them internally for shorter periods if you want to. Some companies generally generate them monthly for comparison, usually for referring against their budget. So it'll be an accumulation of everything that you've earned and everything that you spent out of expenses during that time. So you'll have your gross profit line, which is your gross revenue less your cost of sales, and then you get your net earnings by deducting your expenses from that amount. So on your income statement, you wouldn't have things like how much debt you repaid. That would be on your cash flow statement,
Which is next. So not always found in every financial statement, but in some, in the handout that you have is a statement of cash flows, which is sort of like an accumulation of your individual cash flows. It's stated over a period of time and shows, unlike the financial statements, which are on an accrual basis, where the cash actually went. So you'll be able to look at your cash at the starting point, so last fiscal period, and see all the inflows and outflows. And then you arrive at your ending cash balance for the current period that's reflected on your balance sheet. So there's a few major items on the cash flow statement, different types of activities, and it's just organized for ease of interpretation.
Is everybody familiar with the difference between accrual and cash basis? Or would you like us to clarify that?
Yeah, I think that would be good.
So we've talked about cash flows and budgeting, which is in its simplest form, what money's coming in and what money's going out. When financial statements are prepared for the government filings or for a bank, it's usually done on an accrual basis. As a small case in point, as was alluded to earlier, when you sell a product, and your year end of your company is December 31st or October 31st, as an example. You sell something today. You sell the Gallings coffee cups, but you didn't get paid. You will have an amount owing to you. As mentioned on the balance sheet, there's an item called receivables, accounts receivable. So when you're on an accrual basis, you would set that revenue as of October 31st because you sold those cups today, but you have a receivable, but there's no cash that's come in. And that's the difference between cash basis or accrual. When you do your budgets, because in a startup in particular, cash is king, as they say, you want to make sure that you develop your budgets, develop your cash flows, and then which helps you develop your budgets, which is in a more organized fashion. That's the key thing. But when you have to do your statements for your tax filings or to a bank, you have to convert it to an accrual basis. So you pick up revenue that it was earned by the end of the year, which would then be reflected as receivables, not cash. And on the other side of it, expenses or purchases that you've had, you bought product, but you haven't sold it, or you incurred an office expense and haven't paid it, and that goes into the payable. So the cash then gets moved into the accrual basis and gives you what we call a more truer picture of what you really earned in that period. And so you start with the cash, you go to the accrual, and that's where we help our clients out in doing those statements. And
Sorry, so you're saying the cash is a more truer picture?
No,
No,
the accrual.
The accrual.
So if you were to look at a balance sheet that was prepared on a cash basis, if you made all those sales, but you were only reporting the cash that you received as an asset,
Right.
your balance sheet isn't gonna reflect the actual operations that you had during that time period. It's not gonna show, you know, the assets that you don't have yet for the money that you haven't collected, even though you've done that work. So the accrual basis, it captures those transactions that have happened, but you might not have received cash for. And same thing, like the expenses that you know you're going to have to pay that relate to that period, but you haven't spent the money on yet. Sorry. So the next portion of the financial statements are really the notes, and these notes to the financial statements go into detail and explain the accounting policies of a company, if it's a assurance type of financial statements, or just information on how the business went. So they're not always included, but they really provide additional information for users to understand. And if you were, not necessarily for your startup financial statements, but if you were to pick up a package for a public company, opening that balance sheet or income statement is not going to tell you anything. You're going to flip to the notes and really get down to what happened during the year, what are the clauses, the conditions around their debt, around the revenue, how they recognize the revenue. All that information will be laid out in the notes. So now that we've sort of gone over a really brief overview of the components of the financial statements, we're going to get into some calculations that are really important for a startup company, really crucial for understanding your profits and how much money can be retained in the business. So the first one is the break-even point. Just a really quick show of hands, who's heard of a break-even point or break-even analysis? All right, great. So it's something that shouldn't be a new concept. It's the point at which your sales directly cover your expenses. So you're going to take your fixed costs, those that don't relate to providing your service or manufacturing your product, things like salaries if you need them, rent, those fixed costs, and you're going to divide them with the profit per unit of product or service that you're selling. So those portions, that's all your variable costs, the direct unit costs, like Alan said, the cost of the cup, or the cost to drive somewhere to provide your service. That variable cost will be subtracted from your selling price, and you'll use that to calculate the units or the number of sales that you're required in order to break even, or cover those fixed costs that you have to spend in order to operate your company. So the last point is really important here. If the volume of sales decline, really the only way to break even is to either increase the per unit sale price or cut your overhead costs. And that's sort of a simple formula for what needs to be done. So we have an example here. Just because we're running short of time and it's going to be included in your slide decks, I would encourage you to just sort of walk through it. It's pretty simple, and it's just a really basic break-even calculation that highlights what happens if your selling price increases and your costs stay the same. So there's some considerations when you're analyzing your break-even analysis. The first one that I would stress is the reasonableness of your calculation or of your selling price. If you do your calculation and you find out that you need to sell 1,000 units to cover your fixed costs for the month, you need to step back and think, for my business, am I able to produce 1,000 units? Am I capable of generating sales for 1,000 units? Is that realistic for what I can do, what I can achieve? Can your operation physically handle that amount of output? And you know, if that's what you've set your selling price at to get to those 1,000 units, is that selling price reasonable? Are people going to even be willing to pay that amount?
Okay, so the next one is burn rate. So it's the amount of cash that you need on a monthly basis to run your operations. So you basically take any cash you have coming in, take out your average monthly expenses, and that's your burn rate. So at the beginning, if you don't have any inflows, your burn rate is really just your average monthly costs. If you can, we suggest that you calculate your burn rate based on your actual costs to date. Start out, you might not have a full 12 months, you might have 6 months. Use whatever you can. You can also use the information from your budget if you know that you're expecting certain costs. For example, if you have monthly rent that you just signed a lease for that hasn't been reflected in the previous 12 months, you want to add it in going forward because your burn rate is what you're spending now. So you're going to use your historical information to calculate it, but you also have to take into account things that you know that have changed.
Yeah. So the burn rate, the way it's written there, I always thought the burn rate was the amount of money you needed. How about you were losing every month, but that's not the case.
It's the cash.
It's not your, so it's not the.
Well, it's pretty much the rate at which,
Cash.
the rate at which you're running through your cash or you're using up your cash to sustain your operations.
So not
Using,
Well, I think they're going to run through an example that may help clarify your question.
Here it is. The only other thing before we get to the example is that your burn rate should be calculated on a rolling basis. So as Alan suggested for the budgeting, that as each month passes, you take off the oldest month and add in the newer month to recalculate. Just keep it as current as possible. So
One way to look at burn rate is to say that how fast your cash surplus disappears every month.
so you're down 3,000 every month.
Yeah, every
So if
month.
you
So
start
that's-
off at
that's a
30,000,
burn
you're
rate.
down 3,000 every month.
So in this example, you have 20,000, well, I won't calculate it. You had a $3,000 burn rate. But one of the things I want to point out with this calculation is that if you use the estimated, so in our example, the salaries are 3,000. But if you hired that person partway through the year, and they're going to be there for the full year, you want to bump that up to an annual cost. So you get a different burn rate. So that's why it's really important to keep calculating. We didn't take into account any cash inflows. If you did have cash inflows, for example, if you were generating sales of $2,000 a month, your new burn rates would be $1,000 and $2,000 respectively.
What do you do with one-time fixed costs in terms of a burn rate? Would you factor it out by 12 and use
Usually.
1/12 of that cost into your
Yeah. If you have one-time costs, you would generally split them over the 12 months just because you use an average. Because you might have, there's unexpected things every month. It's never going to be perfect. It's same with the budget. It's just a tool. So it's just to give you an idea of how much you go through on an ongoing basis.
Another option is you could exclude that large purchase from your burn rate. So, I mean, you know that you might need to spend $2,000 to buy something up front. That cash is gone. So really, it might not need to be factored into your burn rate.
You'd have
never
a
buying
lower
that again.
starting point, that's all. Unfortunate, but you'd have a lower starting point.
On the same note, if you're expecting a large purchase, you would want to work it in. So once you have the burn rate, you can use that to calculate your cash zero date. And this is the date that you expect to run out of money.
It's pretty self-explanatory.
If you get no more money in, how long you can survive. So you start with today's date, and then you take your current cash balance over the monthly burn rate times 3, and then times 91 days. That should be fine. So the 91 and the 3 are just to get you on the number of days that you need, and so that'll give you your cash zero date. This formula, it assumes there's no money coming in each month. To work that in, you just adjust your burn rate. I think that's the easiest way to do it. Keeps it as simple as possible. Your cash zero date should also be calculated on an ongoing basis. You need to know when you're going to be running out of money so that you can approach financiers and investors and make sure that you're getting those funds in well in advance of your cash zero date. You don't want to run out of money at any point. You want to make sure that there's always a buffer. So months in advance, you want to start approaching. So we're using the burn rates from previous example. We'll start off with $12,000 cash today. With the actual, you would run out of money on March 1st. So you basically have 4 months before you're done. And with the expected, with that higher salary, you actually know that you're going to run out January 30th. So that's part of the other reason why it's important to make sure you're keeping it up to date. Because if you're having higher costs, you're going to run out faster. You wanna make sure that you're not like anticipating a longer period, because you don't wanna get caught short. So does everybody understand those two calculations?
Right, so, I mean, that's sort of it for our formal presentation. We've included an appendix that has a bunch of other various ratios and calculations that you can use. There are also certain ratios and calculations that might be required as conditions of financing. So if you're approaching a bank or a lender, they might put restrictive covenants on your funds. So if you're preparing financial information that they'll be reviewing on a periodic basis in order to continue to extend funds, whatever, these are sort of the covenants that you'll need to have in place, or the calculations that you'll need to know. So a really good suggestion is to calculate these ratios yourselves. So even before you go in to obtain financing, know where you stand. That way, if you go in and you begin discussion with a knowledge of where you're at, if a lender comes up to you and says that we want a current ratio of X, and you know that that's going to be pretty much impossible for you to meet based on where you're at, you know that you're going to need to negotiate with that person in order to ensure that you're not breaking those covenants on a reporting basis. So you can definitely go through those on your own when we hand out the slide deck.
So that's basically most of our presentation. So we talked about, this is an overview of the financial statements, and giving you the handout that you can refer back to. We talked about the burn rate, cash zero date, break-even analysis. This will help you when you're making plans for the next couple of months. You want to make sure that your data is really good, because your analysis is only as good as your data. If you are using data that's incomplete, you won't have the full picture. You want to make sure that you're really taking the time to create good records. This doesn't mean you need to sit down every single day or every single time you make a purchase, but if you make it part of your routine to do it on a weekly, semi-weekly basis, just keep everything up to date, then that'll really be helpful for you.
So, I mean, that's it. That's our presentation. Sort of going back to the communication objectives that we addressed at the start of the presentation, we wanted to come in here and give you an understanding of what cost structures are, what different cost structures you might encounter, and what are the different types of revenue streams that you can put into your budget and anticipate cash flow from. Explain what cash flow is, why it's so important, and why you need to be aware of your cash flow. We talked about budgets, how to prepare a budget, and why they are a crucial tool for measuring your performance. And as well, we've provided you with metrics for interpreting your financial performance, as well as analyzing trends, and also, gone through those financial statement components with you. So, thank you very much for being so patient, listening to our presentation. We hope you've enjoyed your Halloween candy, and we want to open the floor up for some quick questions.
Before we open up the questions, have we gotten everybody's business card or name on a piece of paper for the draw? Alan has a box, if anybody that hasn't, throw them in.
Lots of people listening online, sorry.
No double business cards.
Yes, can you suggest material or book for people like us, those who are not really, into making tons of money, but
I think basically
who can understand how to, make the organization sustainable?
I don't know any off the top of my head, but I would really encourage you to go to a bookstore or do some research online and see what's recommended and what good reviews are.
I wouldn't want to suggest just one book. I would say try and look at a number of different business books, because you get different opinions and different ideas. You don't want to just take one formula.
Thank you.
Do you have any advice on how to project professional fees in relation to growth?
Can you be a little more specific? Are you talking about legal, accounting?
Yes.
Well, I think your business is developing a product, correct?
Software.
Or a service or a software.
Yeah.
So I think it depends on what you anticipate your professional fees relating to. Primarily legal costs, maybe?
Well, just strictly with accounting, for example?
Well, with accounting, you got two aspects of it. What knowledge you have. There are freelance bookkeepers out there that charge an hourly rate of X dollars to maintain your books if that's not your forte. Some of them can actually do your statements and tax returns. Generally, in a startup, depends on, again, the number of the activity in terms of if you're selling, for example, a product, how many sales invoices you're going to have a month, how many purchase invoices. If it's a service business, then you have less on the expense side, so there may not be a ton of work involved for a freelancer, and generally smaller businesses use sole practitioners or smaller accounting firms, so the fees will be in a few $1,000s tops, in that regard. Legal fees will depend on the nature of your business and the need for them. I mean, obviously, if you incorporate, then you can do it on your own. You can use a lawyer, which usually is in the range of about $1,000, give or take, to incorporate and set up a company. That's the bare bones.
Is there a certain percentage of your annual projected cash flows that you would suggest keeping in reserve for additional professional fees that may arise?
I wouldn't use necessarily a percentage. Again, so much depends on what your needs are. I think what you need to do is, if you feel that you need the use of a lawyer or an accountant, most firms will do a 1-hour consultation for free, and at that point, and give you an idea of what the cost would be for what you're looking for. At least you go in with your eyes open. And you can ask, do you provide any free consultation? But most do. But it never hurts to ask, so you don't find out that somebody surprises you with a bill without realizing that, because each person's different, the way, each firm operates differently, so I don't want to talk for other firms.
Yeah.
I have a general question. What is a good software for a startup company for accounting software? And because there are lots of them, the simple accounting and all that. And some of them are online, some of them are computer-based. Which one will go best? And if somebody want to do the accounting on their own, do they really need some CA to stamp their papers before they hand it to Revenue Canada by the end of the fiscal year?
So to answer the second part of your question, to submit your financial information to Revenue Canada, you're not required to have any sort of accountant certification on them. That being said, they do need to be prepared properly.
Yes.
But if you as an individual have the ability to do so, and you're comfortable with putting those together, that's fine. Where the complexities usually come in is as your company grows and it becomes a little bit more complicated with the different revenue streams and the transactions. That's when you can probably enlist the help of a professional to help you prepare those.
For software, it's gonna depend on your business and how much activity there will be recorded. So if you're in the startup phase and you're not incurring a lot of costs, like if you were more like the research phase, then even just tracking in Excel, just doing a monthly, this is what I spent, this is what was spent on what, this is what money came in. As you get larger, you might want to move to a commercial software, but the one you pick will depend on how you want it to integrate with your business. Some of them will have specific inventory modules that you can use to track your inventory, or they'll have point of sale add-ons that you can use. So it would depend on what you're planning on doing with it.
I think the benefit of using some of those purchased accounting softwares is that they have reporting functions built in. So by entering in your data in a certain way, it'll spit out reports. But again, like what we've been saying throughout the whole presentation, those reports are only going to be as good as your record keeping is. So if you're able to get a snapshot of how your business is doing by using totals in Excel and doing financial statements that way, that's obviously a really low cost, easy way for you to start.
Some of the accounting softwares also have startup versions where it's limited to the number of suppliers or customers that you can put in. So you can start with a lower version, and then you can upgrade, and they'll retain all of your information, but you'll end up paying more.
Do you have an example of startup software?
QuickBooks does that. They have one, I think it's called Easy Start, where I think you're limited to 100 or 200 customers,
Okay.
and then you can upgrade to the QuickBooks. There's other things to consider is that there's some of them, like you mentioned, are online, so you can access them anywhere, but you also want to keep in mind the security of your data. If it is online, that anybody could potentially hack it.
Okay.
The thing to be also be aware of, if you at some point decide to use a freelance bookkeeper who generally charge on an hourly rate of about $50, there's a number of criteria we use when we deal with our smaller clients who use freelancers. A, do they get back to you? Some are really poor at getting back to you and you have to chase after. 2 is, what software package do they use? They generally tend to use one. QuickBooks is one example. 3 is, what tax knowledge do they have? A little bit of knowledge can be obviously dangerous because there's what was mentioned earlier, HST filings, but also payroll. If you have staff, are they doing the payroll deductions for you? Are they correct? Which again, if you're totally relying on them, you want to make sure it's someone, one of your friends, peers who have used them before and said, you know what, they do good work, they know what they're doing, because in a lot of cases they have very limited tax knowledge. They should have the bare bones knowledge about compliance issues. The ladies mentioned before, the one thing you don't want to have to pay is unnecessary penalties and interest.
What about those new fancy startups that do all the payroll deductions and HR, like FreshBooks or?
QuickBooks itself has a payroll function. You know, it's just if you know how to use it properly. You know.
Well, it's supposed to be easy to use.
Yeah, a lot of them are, and they're pretty straightforward. So.
FreshBooks is not QuickBooks.
I'm sorry?
You said FreshBooks, right?
FreshBooks,
Yeah, FreshBooks is a different company.
To be honest, a lot of the companies that we deal with, because they're not in that startup phase, we don't see a lot of the newer software that come out. It's a lot of the accounting systems that they use tend to be simply accounting or QuickBooks, or then into Caseware.
Or they'll use a payroll provider, so they won't be using something like FreshBooks.
So, I mean, for that, let us make use of our free resources. I would go online and just check out reviews and see, like, look into forums and see what people in the startup business community have found.
Has anybody here used FreshBooks?
We use QuickBooks.
Both QuickBooks and Simply Accounting are used widely, so either of those would be fine. I'm not sure if there's really any others that would be like standalone software as opposed to online.
It's free, you brought the gentleman during the first session, I forget the name of that.
And these also spit out the actual versus.
Yeah, you can enter your budget information in them.
And that's sort of what we were talking about in the presentation, making sure that whatever financial accounting system that you're using, it mirrors your budget. So by having a tool like one of these programs, it allows you to compare your information the same way that it's entered in.
You want to give people a chance to eat.
Yeah, so before we break off for dinner, we're gonna get Lalit to pick our prizes.
I will request Sunny to do that
Oh,
today.
sure. Anyone else?
Well, if you pick your own, you got to put it back.
All right. So we're giving out 3 books today. So we'll go 3 cards.
Linda Montgomery? Right there.
Yeah, come out, pick a book.